Hey everybody! In this video, we're going to talk about financing. And when you get a mortgage, it's all about the numbers. It's about your credit score, your income to debt ratio, and the income to mortgage ratio, as well as your down payment. So stay tuned. My name is Tracy Goodwin, and I'm a realtor here in Chilliwack, BC. I work at Century 21 Creekside Realty, and I've been selling homes here for nearly a decade in the Fraser Valley. If at any time you have any questions about real estate, the market, or this video, you can put them in the comments below, or you can reach me at 604-997-6505. My email address is tracygoodwinrealtor@gmail.com. So your credit score is really important. Your credit score can be anywhere from 300 to 850. They are compiled by all the credit bureaus and an organization called FICO, which is an analytical corporation. It's a snapshot into your entire history of spending and lending. Most lenders are always at a low risk, high credit score type mood. And in order to qualify for the best rates, like a benchmark of 30 years at a fixed rate, your credit score should be at least 720 or higher. If you want to know what your credit score is, you can find out for free at www.annualcreditscore.com. Do you know what your income to debt ratios are? In order to qualify for the best mortgage at the longest fixed terms and have your mortgage insured, most lenders look at about 29% of your gross annual income. So if you make $5,000 a month, times that by 29%, it comes to $1,450. So $1,450 has to also include any taxes, insurance, strata fees, as well as the principal and interest. $1,450. Lenders are also going to look at your consumer debt, and they'll allow 41% total, including your mortgage, of your gross annual income. So you make $5,000, times it by 41, comes to $2,050. You minus your house payment, $1,450. You're left with $600 to allow for credit card, student loan, car loan, family maintenance payments, and any other debts that you might have. Your down payment is really important, and the numbers vary. 20% is ideal, 5% is minimum, but if you put down less than 20%, you're required to purchase default insurance. And your credit score will affect the amount that is required for a down payment. So the higher the credit score, the lower the down payment will be required. Where you get your down payment matters. If you've just sold a home and you have some equity, or you've been saving for a long time, that looks good. But if you're getting it as a gift from, an uncle or a relative that has passed away, or your parents have lent you the money, the bank looks less favorably upon those type of gifts than if you were to save the money yourself. There's first-time home buyers incentive plans and other ways you can accumulate a down payment, but 20% is ideal. 5% is a minimum amount. So in conclusion, your credit score, your income to debt ratio, and your down payment are all going to dovetail together to make sense to your lender and help to determine the home that you can afford that's comfortable for you. And just remember, I'm not a mortgage expert. I'm just giving you some basic ideas here to help you determine, when you start looking for a home, how much you might be able to afford. Hey guys, I hope you enjoyed the video. If you did, can you give it a thumbs up? If you have any comments or questions, you can put them in the comments below, or you can reach me at 604-997-6505. My email, tracygoodwinrealtor@gmail.com. Till next time.